Welcome to moneyvaluelab.com. My Instagram followers have voted for me to value Alphabet, so this is what we're going to do today. We're going to value Alphabet, more known as Google. And we're going also to value Alphabet in using my platform, which I built, and which will be available to all my Patreon members. So this is a way to show you how you can value a company. And the good thing is about my platform is that you don't need to be an expert in valuation. It will take care of all of the calculations for you using the discounted cash flow method, whereas you only need to put your assumptions to the stock. But I'm going to show you that. But let's go through the Google valuation. So before we go through the Google, I just want to know that disclaimer that investing in stocks bears always a risk. Now, let's go through my investment checklist, and it's important to go through that before we value Google, because we're going to see the Google valuation through the lens of my investment checklist. So what I look at is management alignment, that you have an owner that owns a stake in the company, so you have that incentive for them to take decisions what is best for the company and not the other way around. Of course, I always look at obvious growth. You want to have a company that is growing and not a declining company, or you have a company, where their products might become obsolete and, they might go in decline or in bankruptcy. So this is something I'll always look at. And of course, point number 3 is compelling valuation, meaning that if I value a stock and I see a 20-30% upside, then I'm interested in buying the company. But of course, if I only see a 5% upside, or I see that the company is overvalued, then I won't buy the stock. And I also look at limited blow-up risk, and what that means is I don't want to invest in companies that have high leverage in form of debt, or for example, it doesn't always need to be debt that is of risk. It could be, for example, that they have a high concentration towards a specific customer. It could be that their product or their revenue is 90% derived from a specific customer. Well, what happens if that customer ends the agreement? Then the company will lose 90% of the revenue. So that's something I always evaluate and look at. So let's go through Google. So if we look at the first criteria of my investment checklist is management alignment. And you can see here that the founders, Sergey Brin and Lawrence Page, they own actually a hefty stake in Google, 3% and 5%. And you need to consider that Google is one of the largest companies in market cap. So owning 3 to 6% in that company is quite big. So that passes the management alignment checklist. Moving on, obvious growth. Well, Q1 2026 showed that Google still are growing really fast. Now, if you look at their legacy products, such as Google Search and YouTube, is still growing at 20% quarter on quarter. And if you look at their cloud revenue, and here you have also Gemini and AI, it's growing really fast, 63%. So having a company as huge as Google and still reporting double-digit growth is, for me, just impressive. Now, looking at obvious growth, does it pass my criteria? And for sure it does. If we look at the legacy products, Google services, where you have YouTube and Google Search, it grew by 16%. So in Q1 2026, the revenue was roughly 90 billion. And if you look at the Google Cloud, revenue grew by 63% quarter on quarter. And that total revenue was 20 billion. So in Q1 2026, Google had roughly 109 billion in revenues, of which 90 billion came from the Google advertising segment. And it shows you that even though you think that Google is a software company, but it is relying heavily from the advertising revenue. So it's not only a software company, it's an advertising company as well, which I'm going to show you later. Well, if we're going to value Google, we need to understand what the revenues will be in the future. And I'm going to do a discounted cash flow valuation, and I need to know roughly estimate what the revenue will be 2035. Well, if we look at the advertising market, it's roughly valued at 1 trillion today, but it's expected to grow 13 to 15% every year, and it will be roughly $2 to $3 trillion by 2035. So that is something we need to consider. Not only does Google operate in the advertising industry, it also operates in the AI market. And the AI market is something now that is booming, it's growing rapidly fast, and it is expected to be as huge as 3 to 700 billion by 2035. So what I'm assuming that Google will take a market share of 40% of the advertising business. So of the 2 to 3 trillion dollars, and they're also going to take 30% of the AI market share. So that will give them roughly $1 trillion by 2035. And to put that in perspective, currently Alphabet's revenue is roughly 400 billion. So it's quite big revenue growth that is required for Alphabet to reach $1 trillion by 2035. But before we go into my valuation page, we also need to consider one thing, and that is Alphabet invests in non-marketable securities, and you could find this item in their balance sheet. And this is important for you to recognize, because here we have $106 billion in non-marketable securities, and you're probably wondering, what is that? Well, these are investments that Alphabet does in other companies. So for example, you probably heard of Anthropic, which is a competitor now for OpenAI. Alphabet actually owns 14% stake in Anthropic, and you have that value here in their balance sheet. And given that they don't own a majority stake in Anthropic and other non-marketable firms, what will happen is you will not see the profit or revenue in Alphabet's profit and loss statement. That means if we miss that out, then we're going to undervalue Alphabet. And now let's move on to valuing Alphabet. So let's now jump to my webpage, which will of course be available for my subscribers. So we will start with assessing the cost of capital for Google, and we're going to then add our assumptions. So what is the cost of capital? Well, this is something that we need to discount our cash flow with when we're going to use this discounted cash flow method. So this is what does it cost to finance by equity and debt. So here I'm going to add Google. Google is the ticker of Alphabet. And what my platform does is it imports all of the required data. Now if we start with equity, here it gathers the number of shares and the current market price of Alphabet, which is $397. And then you get a market value of $4,870 billion of equity. Then you're going to choose the industry. because the industry will then give you the beta. And what is the beta? The beta is how much riskier your stock is in relation to the market. So if you have a beta above 1, it's riskier than the market. If you have a beta below 1, it's less riskier than the market. Now, given, as I showed you before, that the majority of Google's revenue came from advertising and not software, you would say, I'm going to choose the advertising industry. And it gives me a beta of 0.98, which is roughly same risk as the market. Now, the risk-free rate that I'm going to choose here depends on which currency I'm valuing Alphabet, because this is really important. When you value a company, you need to have consistency in your method, because if I'm valuing Alphabet in US dollars, but I'm picking risk-free rate from Sweden, well, the inflation in Sweden will not match the inflation in the US dollars, and that will be a mismatch and my valuation will break. So here it's not important to pick where your company is incorporated, which nation, which country, rather which currency you're valuing your company. So given this is US dollars, of course I'm going to use the 10-year bond American, which is roughly today at 4.1%. Now, important, of course, United States 10-year government bond is not risk-free anymore, right? They lost their AAA rating. I believe they had AA rating, and I should, if I'm a purist, I should remove the default risk from here, so I get the risk-free rate. But I'm not going to do that. It's only here the equity risk premium. This is nothing you need to worry about. I'm going to just put 6% here. This is the risk in the market, and this is something I calculate on a monthly basis. Now, we are done with the equity. So the equity component costs us 10%. It has already calculated that. Nothing else you need to do. Now, if you go to the debt, it has picked up the debt from the balance sheet. It's picked up the interest expense on the debt. Now, important thing to understand, when you value a company, we don't work with book values. Everything is market values, right? That's a big distinguishment. So here I need to convert the book value of debt to market value. And how I'm going to do that is I'm going to treat this book value as a bond. So the interest expense on debt will be my cash flows. And then at year 3, expiration, then I'm going to receive the face value back. And if I do that, I'm going to get the market value. And again, nothing you need to worry about. My platform will do that for you. But what you need to do is to pick the rating for your company. So now in Alphabet's case, we have a rating. So I put actual rating here, the credit rating they get from Moody's, or S&P Global. I believe it's A+, so you get the spread is 0.77%. That gives me a pre-tax cost of debt of 4.1%. When it discounts, when it treats the debt as a bond, I get a market value of debt of 84 billion. You see it here, and the cost of debt is 3.26%. Now you would say, why can't I just look at the current interest expense from their financial statements and add it instead of doing all of this complicated calculation? Well, I'm looking at the future cost of interest expense, not the current one. That's why you always need to look at the future one. Now I have the debt here, and it gives me the total weighted average cost of capital of 9.95%. If you would have preferred stock, I treat it as debt as well, but in this case we don't, so nothing I need to add here. We're done with the cost of capital. And again, the aim here is it for to be simplistic. Now, moving on to the dashboard. What the dashboard does, it gives you a clean view of your company you're choosing. So in this case, we chose Google. And I use this to screen for company if it passes my investment checklist. So I don't put unnecessary work for a company, valuing it, putting hours to this, and then seeing that it doesn't pass my investment checklist. But here we can see revenue growth increasing year by year, EBIT margin 32%. And then you see here something called potential EBIT margin expansion. This is the spread between the gross margin and EBIT margin. So this tells you that EBIT margin could improve theoretically 27.7% above this EBIT margin of 32. So you could have roughly 32.7% plus 27 gives you roughly 60% EBIT margin. But again, this is just a theoretical improvement. But then you have, of course, cost, you have personnel. So not every company will be able to reach that. But this is good to just gauge the spread between the gross margin and EBIT margin, because if you would assume in the future that Alphabet would have an EBIT margin of 70%, I would tell you it's impossible, because their gross margin is 60%. You can't have an EBIT margin above your gross margin. So this keeps you in check so you don't overvalue the company. Now, if we look here to the right, annual average growth 16.7%. This is really impressive. And if we look at the expected future growth next year, that is something I consider based on how much the company reinvests in their business. But this is something I'm going to show you later on. Now, because we chose, we have a cost of capital now of 9.9%. This here looks at the economy value added. So is your company destroying shareholder value, or is it increasing shareholder value? And the way you look at it is by looking at return on invested capital minus weighted average cost of capital. And if it's positive, it gives you it gives value to the company while it grows. And this screener shows you that, because if this was red and it was negative, then that's probably a company I wouldn't invest my money in. So I've done all of this work for you, so you could just add your company, and if you see something that is red and a warning sign, avoid these companies. Now, earnings per share, we can see that it's growing every year, really impressive. But also I have a line chart here capturing the stock-based compensation. This is really important because a lot of American companies have stock-based compensation. They say it's free money, right? They're not paying salaries to their managers, but they're giving away equity. And what that will do is it will dilute shareholders. So if you're an owner of Google and you have a stock-based compensation which is really high, you're going to be diluted as a stockholder. This is nothing that will give you value. But however, if diluted earnings per share are still growing, which it does here, then you don't need to worry. But if I would see the diluted earnings per share declining, and as I see stock-based compensation increasing, that would be a warning sign. Here is just market ratios, the PE, and you can see the PE now for Alphabet is around 30 and it hasn't been that cheap through 10 years of history. Here you have the debt ratios. And remember, we spoke about limited blow-up risk of my investment checklist. And you can see here that the equity ratio for Alphabet is 68%, meaning they have 68% equity, the rest is debt. And that is really low. So it's a strong balance sheet. And you can also see here that the total debt is 90 billion, but in cash, they have 126 billion. So they have net cash. They have more cash than debt. And that brings about $2.97 per share. So for each share in Alphabet you're buying, you're getting $3 for free. Really good. Now, if we go here, which is the most important thing, which is the free cash flow. Here, my free cash flow is without stock-based compensation. Many American companies adds back the stock-based compensation. If you're wondering how that looks like, if I put it here, and if we go to the cash flow statement, where do we have it? Yeah, here we have the cash flow statement, net income, and then they add back stock-based compensation. For me, I disagree with that. Not only me, but even Warren Buffett have spoken about this, that stock-based compensation is a real expense, nothing you should add back because it dilutes you as a shareholder. And that is something here my platform does automatically. It doesn't count in stock-based compensation. And you can see here by latest trailing 12 month, free cash flow for Alphabet was 23 billion. And here below is the reinvestments, how much they reinvest in capex, how much they reinvest in working capital, and it's been a whopping 91 billion. And much of it is due to the data centers and investments in AI. And here you see the free cash flow yield. And based on how much they reinvest, my model could calculate the future growth of that company. Sorry for that. So given that they have been reinvesting heavily, my model tells you that they might grow 15.6% next year. Now, let's go to the valuation page. Right, we have chosen which industry Alphabet operates in. Now, we're going to value the company. So all of the input cells here, revenue, operating income, etc., all is being automatically inputted. Now, if you want to override any input cell, you could of course do that. So for example, operating income, if there would be one occurrence of an expense or write-off that I know that it will not happen in the near future, I could of course put manual here and adjust that. But for now, I will not adjust anything. The cross holdings, remember, Google or Alphabet owns a stake in Anthropic, and they own more in other non-public companies, and they don't show up in their operating income. Why? Because they own less than 20% stake in these companies, and accounting rules does not allow the Alphabet to capitalize them as revenues in their own profit and loss. So I need to add them back. So let's see here, how much were they worth? $106 billion. So let's put that here. 106,946, like this. I'm done. Now, how much? Here is the assumption. So again, in valuation, you have number crunching and you have the storytelling. The number crunching is the part that my platform will take care of. Nothing that you need to worry about. But the assumption is something that you need to add, your inputs. So I'm going to assume 15.6% revenue growth next year. Their current EBIT margin is 32.7. I'm assuming 33 next year. And I'm going to assume roughly 10% revenue growth over the 2 to 5 years. And their target operating margin in year 10, I'm going to assume will drop down to 31%, given higher competition, etc. And the year of convergence, when will that happen? I'll put that in year 10. So operating margin will increase to 33% next year, but will decline and converge to 31% in year 10. Now, sales to capital ratio, you're probably wondering, what is this? Sales to capital is how much revenue the company gets for each invested dollar. So the higher the sales to capital, the less reinvestments the company needs to do. The lower sales to capital, the higher capital intensity the firm requires. Now, let's put 1.2 here. Marginal tax rate 25%. Risk-free rate 4.1, as I added before. This is already calculated. We have already done that. This is the future WACC. It gives you that straight from the bat. And I'm going to override. It tells me I'm going to override the future return on invested capital. But before I do that, let's go through the assumptions now. So I added revenue growth 15.6% next year. It will continue growing by 10% and will decline to the risk-free rate. So I'm going to have $1 trillion in year 10. Fine. Operating margin, I added 33% and it will decline to convert to 31%. And the reason is, my story is, the competition will grow, it will increase. Remember the sales to capital ratio which we added? This is the reinvestments. Because look, if I add $5 in revenue for each invested dollar, reinvestments will get lesser. But that's not realistic. So I'm going to put here because, you know, Google will invest heavily in data centers and cloud. So here reinvestments I have is 40 billion, but maybe this is too low. If we go in and probably look at Google's communication with management, they probably have announced that they're gonna invest 100 billion. So just an FYI, something that we should definitely do. But if I just leave it here as 1.2, and you're probably wondering, well, how do I know if it's too less or too much? Here I have the industry data for you. Now this is for advertising. Of course, you need to look at the software industry as well going forward, because Alphabet will become more AI heavy going in future. But here you see 10.9% reinvestment. So this is probably too low. I would probably keep it 30 to 40 to 50%. And you could also look at the dashboard. Here you go down, you could see here's the reinvestment, 56%, 57%, 80%. So I'm too low. Let's actually increase that one to, I'll probably put 0.9. Nope. 0.9 like this, and we get much heavier reinvestments. That's better. Now you see return on invested capital. Keep track of that, because the more you invest, the more you will have invested capital, and then you're going to get a return on invested capital. If you are not investing enough, your return on investment capital will blow up. It will come 50, 60, 70%, and that's not realistic. So something to keep in mind of. Now, I'm done. I say here in year 10, return on invested capital will equal cost of capital, meaning you will not have any edge left. But I'm assuming, you know, Alphabet is a unique company. Even though when they become mature, they're still going to be able to deliver products and services that are unique. So I'm going to give them a 15% return on invested capital year 10. What that does is it's lowered the reinvestments for the company. Because look, when I didn't have it, it was 46%. That will increase my value per share. So it gives you the value. Remember, we put the cross holdings of 106 billion. Here you have Anthropic included in that as well. And now I just go and I press calculate value. And it gives you $187 per share. Currently, the stock is trading at 397, meaning the stock is overvalued. And again, these are my assumptions, so there's nothing wrong or right. You could put your assumptions and you could get a different value. But important that you need to anchor your assumptions with reality. If you just put, you know, if I just put 20-30% revenue growth every year and you're going to get $2-3 trillion, it's not realistic, because remember, you have competition as well. But again, the stock was trading at $150 in May 25. So, you know, in hindsight, yeah, one should have bought the stock and you would have doubled your money. But for now, I would say Alphabet is too expensive for me. And it's not about buying good companies, right? It's buying companies at the right price. This is when you make money. So this is a framework I do for every company. And the good news here is that you as a subscriber will be able to value any company like a professional. These calculations, these formulas in the background are doing all of the work for you. What you just need to do is put in your assumptions. I hope you find this session interesting and that gave you something. And of course, when I launch my website, I'll also launch educational videos. So you start with watching them first before you start valuing your own companies and building your own portfolios. You're probably wondering, who am I behind the screen talking? Well, I have more than 24 years of experience in the banking industry, and my experience has been mainly lending money, so I understand cash flow, I understand valuation. And valuation is a hobby of mine, something I do every day. Hope you find this video interesting, and I'll keep you posted when the webpage will launch. Have a good day. Bye bye.